Hello everybody and welcome to another one of IRONSHIELD Financial Planning's Fly on the Wall webinars. My name is Scott Plaskett and I'm a certified financial planner and the senior financial planner and CEO of the fee-based financial planning firm IRONSHIELD Financial Planning. If this is your first time tuning into a Fly on the Wall recording, let me quickly explain to you what this is. You're going to experience what it's like to be a fly on the wall during one of my update calls with a member of our Top Guns network. This network is my personal network of specialists. Every so often I ask a member of my network to touch base with me to bring me up to speed on the latest happenings in their area. And when they call me, I record the call so you can be a fly on the wall for that call. In today's episode, I have an update call with Charles Wilton, a portfolio manager at Raymond James Limited, a Canadian subsidiary of Raymond James Financial. Raymond James is one of the most respected investment management firms in North America. I love speaking directly to portfolio managers about their process. Process is so important to investing, and when I can get a portfolio manager to explain their process in plain English, we all benefit from this wisdom. Now, here's the call. Okay, Charles, listen, thanks for taking the time today. I know in your portfolio there's been a recent disposition that I wanted to talk to you about, the CR Bard position that you had in the portfolio. And obviously it was time to sell, and I just wanted to find out from you kind of what the history was on that, how things transpired, and what was it that really signaled you that now is the time to maybe exit the position, because, you know, investing is not just about the right time to buy and buying at the right price, but it's also, you know, selling at the right price and knowing when that time is. So I was hoping you could just go through some of the details behind that, and we'll just have a bit of a chat about that.
Okay, fine, Scott. Well, we bought CR Bard in October of 2009 for $75.
And what was the company? What did the company actually do? Just as a bit of an aside.
Well, the company's in the medical supply and medical device business. They supply hospitals, they supply doctors with catheters and a multi-array of things to old age homes or senior citizens, anything to do with taking care of patients.
Okay. So yeah, kind of a recession-proof business.
Right, and they're also global, and they're also growing very rapidly.
Yeah. Okay. Good. Well, that's good. I just wanted to sort of paint the picture, because not everybody who holds the portfolio kind of knows about all the companies in the portfolio. I mean, some of the companies are pretty straightforward what they do, but a company like Bard, CR Bard, isn't. It doesn't just jump out off the page and say, "Oh yeah, this is what the company's in." So I appreciate that little preamble.
Well, that bodes good for us, because if we're looking for what we're trying to do is we're looking for predictable businesses and good businesses, and preferably under the radar for a lot of people, which in a lot of cases shows up as misguided expectations in the market. So what we're actually looking for is we're looking for a company that we think the market is mispricing because of what their expectations are. And CR Bard came in October 2009, and the value is very good. Now, the value in other companies were good too as well, but we're trying to emphasize more of a predictability aspect to keep the volatility out of the marketplace.
Right. So this was purchased back in 2009, you said?
Yeah, in October for $75.
Oh, okay.
Now, the flip side of that is when we're watching our kids' hair, we want to make sure that everything is going according to Hoyle. And one way that we do that is we're constantly looking at the data to see what the company's doing from an economic point of view and what the market is expecting the company to do.
Okay.
And in particular cases, we know that the accounting, when one looks at the accounting of a business, and this is what they say, the earnings per share and EBITDA and lots of things to do with accounting, it is an opinion, it is not fact, and we also know that accounting is based on credit rating, not the profitability of a business. When we're looking at the profitability of the business, we have to look at the economic earnings versus the GAAP. And why we do that is because the economic earnings are based on a complete set of financial information available, and it's standard for all companies, and a more accurate representation of the true underlying cash flows of the business. Therefore, the economic model based on all relevant financial information is required to assess the economic earnings of the company, which is why doing a deep dive is very important to match what the expectations are versus what the actual earnings are. Now, in Bard's case, things were going along, things are moving along very nicely, and we see that the earnings started to plateau in 2012. So from 2011 and 2012, the economic earnings versus the GAAP earnings were flat. So the economic earnings, where they say, well, they earned $3 a year. Well, for example, they come out with their earnings just recently, and their earnings were $8.58 a share.
And this is you're referring to the chart that we have on the screen here, the blue and red line chart. Maybe you just want to.
Right. Well, this is basically this is not all of it, but it's the summary and it's the bullet points that guide me to doing more analysis on the company.
Sure. Yeah.
So what happened is we see that they reported earnings of over $8 a share, but when we reconcile the GAAP accounting, we came up with $3.31 a share.
Okay.
So there's also a disconnect there. So what is the disconnect? And this is why the GAAP is the problem for trying to understand the profitability of the business. Because now we've got to go deep dive into 90 pages of footnotes. We've got to go through all that, bring it all out, standardize it, flip it, mark it back, and see that what actually happened is Bard won a patent lawsuit against the company for roughly $900 million. So what happens, there was some expenses to do with that, some taxes to do with that. But what Bard did is they reported the net income from that one-off lawsuit as EPS, earnings per share.
Oh, okay. So really, it had nothing to do with
what happens is they totally inflated their earnings. So one might look, if they're looking at the GAAP aspect, saying these earnings since 2011 have been going crazy, or in fact they haven't been going crazy. So what happens is they, in my opinion, and if you're running a business, that we take out the one-time charges.
Right.
Because they're one-off. So if they wound up losing a patent suit for $500 million, we would take that out of what the actual earnings per share is because they're a one-off.
Mm-hmm, mm-hmm.
Unless it was such a big thing that it really affected the business. But for the most part, what we're trying to do is we're just trying to figure out what is really happening in the business and to isolate the one-offs to the point that we don't like it when companies start taking advantage of that. And now when you look at what the value, so the stock got to 150, now it's trading at $135. So the stock is off.
Mm-hmm.
But to the degree that the market is valuing this company the way that we think they should, being conservative business people, it's still overvalued. Now, it's not a bad company, but what they're doing is you got to watch the management when they start pulling these tricks. So at 135, what the market is saying is they're going to have to take their revenue growth and they're going to have to double it over the average of the last 3 years. They're going to have to double their revenue growth on average over the last 3 years for 6 or 7 years to get to the point that the stock's worth 135. Now, the stock's up 100% from the 2009 low. So you can see from January, late July 12, the stock is basically in a parabolic move.
Mm-hmm, mm-hmm.
So we look at that as dangerous. So what do you think is going to happen for the market to, now given that the market has already had big moves and given the S&P was up 30% and given the bullishness of the market and where the market is now, we also know that as companies start going up, especially companies like these, we have to be extra diligent trying to find where the actual value is. So the odds of this company going from 135 to 175 or 180 or 190 over the next 12 to 24 months, to me, will not happen.
Right.
It's just the probabilities are way too low for that to happen. So we take our money and we go and we're going to play somewhere else.
Right. Yeah, because in this case, you've basically seen the price of the stock get ahead of its true value, and the market is saying that it's worth more than it really is, in your opinion. And that
the company is not saying anything. The market is interpreting what the company puts out as really what's happening, and they're trying to extrapolate what they feel in the future the company's worth, which is why every day the stock trades at what the market says it's actually worth.
Mm-hmm.
Now, if you looked at it from another point of view, you look at somebody else's reports, and they would think, okay, this looks good, and it's fine, and it's a really great business, and things are looking good. But they're not accounting for that $900 million one-off. Now, from a realistic point of view, if you were going to go as an individual and buy this company right now, and they said that they made $8.58 a share, and you went through everything because you're buying it, you say, well, no, you really didn't, because you got a $900 million gain on a one-off. So that's not part of what the business is. What is the business worth if you take out the $900 million? It's not worth this. So you're not going to pay, Warren Buffett's not going to pay them $150. He might pay them $80 or $90, but...
Right. If you're looking on the chart, though, that you've got in front of us here, that's where your blue line, the economic EPS, is really what you feel it's worth, versus the red line, which is what the reported earnings per share were. If you looked at the blue line, if you want to know what Warren Buffett or a lot of really intelligent people, Jack Welch, look at when they go to the business, when you go in, so if Warren Buffett's talking to C.R. Bart, he's looking at the blue line, not the red line. The red line's crap. It's GAAP accounting, and it is misconstrued. Yeah.
It's misrepresenting the true value of the economics of the underlying business.
Yeah, I totally get it. Totally. Okay, super. Well, so that was a healthy profit made on that particular position. Obviously, it was recognized, back in 2009 as a good value for the price that you paid for it back then. And now things have obviously roared forward, but the company's underlying value is not justified, or is not justifying the current price. And the price has gotten ahead of itself, and so that's really an indication for you that maybe it's time to give a great company, because you're not saying this is a bad company, I don't think. You're saying it's a great company, but you're saying, hey, the market's just saying it's pricing it at a higher point than it really should be. So why not give it back to the market and let the company come back to a normalized level, when maybe at that point you might entertain buying it back again?
Exactly. Now, and the companies that I sell are not bad companies that are overextended. They're all good businesses, or we wouldn't buy them in the first place.
Right.
So the same as Nike, but most of the times when we sell a business, we buy the business back at lower prices.
Mm-hmm.
So most of the time, the businesses that we sell don't go on to greater heights. And if they do, in one particular case, Starbucks is 3 times overpriced as C.R. Bard.
Right.
3 times. So if you looked at, you'd say that Starbucks will double and triple its business for the next 30, 40 years to be worth where it is now. Now, the company went up higher after I sold it, but that's no man's land and nosebleed land.
Yeah.
Our job is to protect the money and to buy good businesses at good prices. So if Nike comes back to the point that it's valuable again, fine. If C.R. Bard does, because they're good businesses.
Yeah.
And this is why the most successful people in the investment business understand that it's mostly about the price.
Mm-hmm.
You got a bunch of good businesses, so it's mostly about the price. So if Coke or Pepsi or any other company undervalued or overvalued, it really is mostly about the price.
Yeah.
So we sold it at 141. If it's down, well, maybe a year from now it might be at 100, it might be at 90 or something. And if it looks and everything is okay still, then we'll just go back into the business. But this is a prelude of what's going to happen. So when we start looking at these businesses that we sold a year from now, we're thinking it's good we sold it because it's all dead money.
Mm-hmm, mm-hmm. Yeah, well, it's great. I mean, I love the discipline, and that's where really what's important here is that there's a discipline when it comes to buying, there's a discipline when it comes to selling, and you make a good point by saying, the discipline doesn't tell you whether the business is good or bad, because they're all great businesses, because you wouldn't buy a bad business in the first place. The discipline just simply gives you an indication as to when it's right to hold it and when it's right to not hold it and give it back to the market. So. That's great. Well, I appreciate you sort of going through and walking through sort of the evolution of C.R. Bard and why it was purchased in the first place, what it was.
And why it's a good business. Why we enter into a business. There's many things that have to come together. Mm-hmm. One would be the predictability factor. The other would be the ability of management to increase free cash flow and economic earnings and make more than their actual cost of capital to be very profitable and to be growing the business. Those are the seeds of a good business, and plus management. So we're not buying these businesses by accident. They've already proven themselves. Mm-hmm. What we're trying to do is wait for some anomaly in the marketplace or some headline event that creates an opportunity for us to go and buy something.
Yeah, and that really speaks to the high margin of safety that you've talked about in previous calls. When you build that in, and you have a high margin of safety when you're buying established, credible, high quality businesses. It's not like this is a flyer that you're taking to see if maybe the business is going to take off and maybe the idea will work. It's already been a proven business that's been proven to work and is a leader in its category. But you're more speaking to the fact that there's a discipline on when's the right time to buy and when's the right time to sell, and that's based on the price versus value. And if you don't know what the business is truly valued at, case in point with this, where the earnings were being reported at $8 a share, and they'd been going nothing but straight up. But the reality is that had nothing to do with the business, so those earnings were kind of artificial. It's being able to dive into those details to really get a clear picture of the business that makes you, make better decisions based on better information. Plain and simple. Is that
right? And that's true. And these businesses, there's 20,000 businesses out there doing what they're doing, and we're looking at the market each day. The market's going up, and the market's going down. And things are moving, and things are being volatile, and we're just looking out on radar, say, okay, we're identifying good businesses. Okay, is there something going to happen that will trigger the buy? Is there something going to happen? That's why volatility is important for us to buy good businesses and huge market moves.
Right.
So if the market went down 200 or 300 or 400 or 500 points next week, that would be great because we would be able to upgrade some of the business that we had. It's like Mike Holmes says. He finishes the house, he brings the couple in, and the wife said, I love the collar, I love the cabinets, I love the tile. And Mike says, do you know what I love? And she says, no. He says, I love everything you can't see.
Right.
I love the plumbing, I love the wiring, I love the heating, I love the structure.
Yeah, everything, all the foundation.
Everything she can't see, he loves. So everything that I like has to happen behind the scenes before I buy the business.
Yeah. Well, that's a great analogy. Well, that's super. Well, listen, Charles, thanks so much for taking the time to go through that, because I'm sure, clients are wondering, hey, there's been a disposition in the portfolio. And now this kind of speaks to why, the business was sold, which also speaks to the discipline that you really follow. So I'm interested, in a future call, to find out a little bit more about what you did with the money that you created for the portfolios, because if you sold something, that means that you've now created a cash position in the portfolio. So I'm anxious to in our next call to find out what you're going to do or what you've done with that cash position, and we'll sort of talk through one of the buy
we'll
sides.
do that. I'm just thinking as we're talking now. With this kind of a discipline and doing a lot of upfront work, doing the basic diligence way before we buy the business. I can't remember selling a company for below what we paid for it in the last 10 years.
Yeah. Well, isn't that the purpose of, isn't that investing? To give people back more than they've given you.
So the whole premise is, all your best work is done up front.
Yeah. Yeah.
Before you get into the business, and then it's monitoring the business after that, rather than waiting for some new thing or something to happen to the business that you're unaware of after you bought it.
Yeah. Well, that's great. Well, listen, thanks for giving us a chance to look under the hood and sort of see some of the behind the scenes. And I always, as always, look forward to our next call.
Thanks, Scott.
All right. Thanks, Charles. Thank you for listening to today's call. If you require further information or have a question relating to today's call, please go to the comments section in the show notes below. Ask your question or make your comment and we'll respond directly online. If you would like to take advantage of a free, no obligation appointment, please call me at 416-626-6515. Or you can visit us on YouTube by checking out our YouTube channel, youtube.com/IronShieldCFP. Follow me on Twitter, twitter.com/IronShieldCFP. Like us on Facebook, facebook.com/IronShieldCFP. Or you can connect with me on LinkedIn.